JJ the CPA here, hope you're doing well. We're gonna cover if you're pulling money out of retirement early in 2020, because there are a ton of new exceptions that help you, some relief, and let's talk about that. Here we go. All right, so the first thing I want you to know is that I'm shooting this specifically for a good buddy of mine that is a lead singer of my all-time favorite covered band, and we were just doing some conversing, and he was just wanting to know how it works. Don't know that he actually did anything. He was just curious. Might have been even asking for a friend. I don't know, but he was just kind of wanting some details, because everybody is probably thinking, okay, if I need to get to my retirement and I'm not 59 and a half, how do I go about that? And then how does it work for tax purposes? Know this, in normal circumstances, you pull the money out, you have a 10% penalty if you're under 59 and a half, and you have to pay tax on it. So it's insult to injury, because you're pulling money out of retirement early, you're pulling it out so it can't continue to grow, you're paying tax on it, plus a penalty. So the benefit that we have in the CARES Act is that they've waived the penalty if you pull out 100,000 or less and it's due to COVID reasons. And then if you are pulling out 100,000 or less for COVID reasons, they also have waived the requirement to withhold any taxes. And then you actually can decide to pay it back, and you have up to 3 years to pay it back. You would pick up a third of it in 2020 as income, a third in 2021, and a third in 2022, meaning you would spread the tax consequences up to the 100,000 and also not having to pay penalty. So that's the overall, but look at what I got behind me. So let's now go through it in detail, because this is what I'm going to be covering. And what I'm going to do here is we're going to have two whiteboards. So we're going to go through this whiteboard, and right before I go to the next film, I'm going to do a close-up. So the reason I'm telling you this is be ready for this. I'll let you know, but I'm going to do kind of a little bit more of a close-up on this, so you could do a screenshot that kind of helps if you're wanting to refer back to it later. And then when I do the next whiteboard in the same video, I'll start that by doing a close-up, so you can do a click of that one as well. I haven't done that in a long time. That was something that I did regularly with my whiteboard when the pandemic first went into, or still hit everybody. So the one thing I want you to know is that we're talking about 401k, 403b, IRA. So we're talking about pulling money out of retirement, not your savings account, not a CD, not a money market, okay? It has to be that those things would be inside one of these. So 401k is usually if you have your money at a private company, meaning public, private, not government. 403b is going to be government. IRA is, well, I left the company, I left the government, and I rolled that money over into my own IRA, and or you've been putting money into the IRA. So most people, they're pulling money from their IRA. But nonetheless, it works the same for any of these. And I'll tell you this, there's like 4 other kinds of retirements. So if you have a qualified retirement plan, I'm not gonna list them all, but maybe 2% of the population is in one of these other 3 or 4. Long story short, this is money that you're pulling out of retirement. That's the terminology, be qualified funds. So early is you're pulling money out before you turn 59 and a half. So if you're pulling it out early, then you have this 10% penalty. So the CARES Act basically says, okay, and the CARES Act is what came out March 27th of this year. This only applies to year 2020. Okay, so I'm just going to make a note here. This is only 2020 that this applies to. Out of the CARES Act, if you pull out up to 100,000, there's no penalty on it, meaning you're not paying the 10%. Now you might already be thinking of a question about the penalty, so hold that thought. When you have the CARES Act, okay, if it's due to COVID, right, you're having financial issues due to COVID, whether it's just your business closed down or you have out-of-pocket medical expense related to it, or your spouse that makes money can't work. My point is you need to be financially affected by COVID. There's really no definition of that other than you need to say that you've been affected by COVID, meaning you need to have been affected by COVID. It can't just be like, you know what, I think I'll pull some money out and get that speedboat, or maybe I just want to pull the money out and have it in my savings account just in case. Here's why you don't want to do that unless you have to, is that it's still going to be taxable. It's still taxable when you pull the money out. Just no 10% penalty in addition to the tax. And the next whiteboard I'm going to have, I walk through what that actually looks like. And then the withholdings is waived. So normally when you pull money out early from your retirement account, the institution that is sending you the money is required to withhold 20% federal, and then, depending on your state, my home state, 5%, right? So they're going to immediately withhold it. So what you have to think of though is when they're withholding that money, it doesn't have anything to do with the penalty, doesn't have anything to do with anything. What I want you to think of it as is when you get withholdings on wages, okay, this works just like that. So think of this, when you get wages and they withhold tax, you wouldn't think, I've already paid my tax on that. What you know is you have to go file a tax return once a year. You reflect your wages, you reflect the amount of withholdings, and if it was too much, you got a refund. If you didn't withhold enough, you owe tax. So just think of it the exact same way you would if you were having wages and they were doing withholdings from that. So this didn't pay for anything. This doesn't pay for the 10%, it doesn't pay the tax on it. It's towards the tax. It's towards the penalty if there's gonna be one. It's toward it, right? So if you have wages and you get paid, $50,000 a year and you have $5,000 withheld and you go to do your tax return and you're like, oh, my tax was only $3,000, you got a $2,000 refund. Same scenario, but your tax is $7,000, well, you owe $2,000. Point is, this is still taxable. If they're waiving the withholdings, that means you got to come up with it later. But the reason they've waived the withholdings is you do have the possibility, or if you elect, to pay it back. So that'll be also on the second white screen or whiteboard. So let's just do this and then we'll go into the next one. So pulling money from one of your qualified accounts, typically these, this is addressing if you pull it early before 59 and a half, okay? Out of the CARES Act, there's no 10% penalty up to 100,000 if you can show it's due to COVID. It's still gonna be taxable. You're still gonna pay tax on it, just like wages. Still gonna be taxable. They've waived the withholdings, and think of it just like the wages when you have withholdings on that. And whatever you pull out, that's the taxable amount. Okay, it's not, well, if I pay tax in, do I only pay tax on the net? No. If you pull out 100,000 and you elect and allow them to withhold these taxes, and so you only put in your bank account 75,000, you're paying tax on 100,000, just the same as when you receive wages, right? Your wage might be, 50,000 a year, but you didn't put 50,000 in your pocket because there were all these withholdings. So you don't pay tax on your net take-home paycheck, you pay tax on your gross pay, just the same as this. So I'm just trying to parallel payroll wages to how this works. You get a Form 1099-R. So a Form 1099-R is what the company will send out in January, just like when your employer pays you a wage, you get a W-2 in January. So I'm gonna do a close-up here, and then magically we're gonna come back and there's gonna be a new screen. All right, so give me a sec here. We'll kind of line this up. All right, I think we've got everything. Okay, You can screenshot it to refer back to it, screenshot it to refer back to it, and see you in a second. Okay, so take a screenshot here. It's the new whiteboard that we're gonna go over, and then we'll wrap this up. All right, hey, let me tell you this really quick. I got a $1,000 contest, like literally want to give you $1,000. So since we're in the middle of it, I released my second book, JJ the CPA, Cracking the CPA Code. You can find it on Amazon. Just search JJ the CPA, pretty simple. Buy it, email me a receipt at jj@jjthecpa.com. Email me your receipt. I put your name in the hat, and then on Friday, September 11th, between 4 p.m. Central Standard Time and 5 p.m. Central Standard Time, Central Daylight Time, I'm going to draw a name out of the hat, and that person wins $1,000. You have to be on the live to receive the $1,000, but nonetheless, buy the book. So in the body, I've got all that info. I got a link where to buy the book. I've got the email, got a link on my website, and we actually have some other contests on all my social media about that. All right, hey, so we're going through these calculations, and you took a screenshot of the prior one and the new one. So let's look at our scenario here, okay? So we're walking through an example. The example is that somebody has pulled from retirement, 401k, 403b, their IRA, $36,000. We know that under COVID, there's not going to be any penalty, assuming that the distribution is less than 100,000, which it is, and assuming that it was due to COVID financial hardships. So you have three options. Okay, number one, you can just pay tax on the full amount in year 2020. So you just report the 36,000 and walk through an example. You have another option. You can pay the tax, in essence, or report this over the next 3 years. You'll pay tax on it over the next 3 years. Walk through the example. The third is just to pay it back over the next 3 years. You can just pay it back. So let me walk through each example. So remember, we got three options. Don't want to assume anything that happens in the first has anything to do with the second, or anything in the second has anything to do with the third. So we're going to walk through three distinct options that you have on this 36,000. The one thing I'll note to you is that no matter when you do one of these three, there'll be no penalty. So if you pull the money in 2020, this applies to those exceptions out of the CARES Act. All right. So option one, you're going to report it all. So assume this person has 50,000 in wages. They got 36,000. So they're going to report 86,000 on their individual tax return, wages plus the retirement. Okay, so of course we know there's deductions and credits like kids, right? Your normal deductions, right? There's no new deductions because you took out of retirement. I'm just talking about itemized deductions, the mortgage interest, or the standard deduction, credits on the kids, all that stuff. Then you're going to take whatever your tax is less what the withholding is to determine if you have a refund or an amount due. So any withholdings out of the 36,000 just get applied to whatever that tax is, just like in wages. So if you had taxes withheld from wages, taxes withheld from the retirement, then that's all part of your taxes withheld. You go, well, here's my total tax. What did I have withheld? What's the difference? Due or refund? Am I going to owe or am I going to get a refund? So there's no separation of this on the tax return. You don't have two separate calculations on the tax return. So if you elect not to have any withholdings, well, you report it all in 1 year. That tax is going to be due no later than April 15th of 2021. So now let's go to example 2. You say, well, I want to go ahead and pay tax on it because I'm not going to pay it back. I want to pay tax on it. But it would be wise to go ahead and pay it over 3 years. If you're not going to pay it back, this most likely is going to be your better option. But the only reason that you may want to report it in 2020 is, what if unfortunately you lost your job, let's say in March, and you don't get to work the rest of the year? It might make sense to report it all in 1 year, because if you don't really have that much other income, remember what you pull out of this is taxable. So if you don't have a lot of other taxable income, then it would make sense to maybe report all of this in 2020. And you don't really have to decide this until you file a return in 2021. Okay? You got the money out. You're now going to decide before you file your 2020 tax return, which one of these two are you doing? Actually, which one of these three? So if you're going to pay the tax over 3 years, what that means is you're going to report this over 3 years. So here's how that works. In 2020, okay, there's 36,000. In 2020, you would report 12,000 from retirement. No penalty, no 10% penalty. You're going to pay tax on it. So your tax return in this example would show your income is $62,000. When you reported it all at once, the income's $86,000 because you reported it all at once. So then whatever your tax is in 2020 and whatever your withholdings are to offset it, that's what your tax is going to be. And then it's just a duplicate in 2021 and in 2022. You're just going to report 12,000 of this each year. It is tracked by the IRS. It is tracked when you report it, okay? How? When it gets to tax time, you'll know, but there is a way, because the IRS is going to know that you got 36,000. There'll be a form that you say, I received 36. I'm going to report 12 in 2020, 12 in 2021, and 12 in 2022. So then you're paying the tax. Even though you're paying tax on a third of it in 2021 and 2022, it's still no penalty because you originally pulled the money out in 2020. Now, the third option is what I would recommend, is that there's no tax, but that you pay this back. Okay? So you pay back the $36,000, if you're able. So how does that work? Well, by the 31st of each year, okay, you're going to pay $12,000 back in 2020, $12,000 back in 2021, $12,000 back in 2022. So whatever you don't pay back, you're going to have to pay tax on. And if you don't pay it back, you got to go back and amend and pay tax. So once you decide what you're doing, you got to stick with it. So if you decide you're going to do that and then, you can't pay it back, you got to go back and amend your return and pay tax on it in 2020. You don't say, well, if I didn't pay it back in 2021, I reported in 2021. Wrong. If you don't pay it all back, you have to go back to 2020, amend your return. There'll be penalties and interest. It has nothing to do with this penalty. This is an early withdrawal penalty that I'm talking about. This would be a penalty for paying your tax late. So if you're saying you're going to pay it back, then you need to pay it back. But you pay back 1/3. Can you pay it back earlier? Yes. It's just that 12,000 of it's due by 12/31/20. 12,000 is due by 12/31/21, and then the last 12,000. But if you got to the end of 2021, you're like, hey, I just want to pay it all back. That's fine. It's just that the last 12,000 has to be paid by 12/31/22. Now on this, if you decide you're going to do a third, and then you're like, you know what, I'm going to go ahead and pay this back, you got to go back and amend your return for 2020. So you do have until April 15th, 2021 to figure out if you're doing option 1, 2, or 3. But then once you select that option, you have to do it. And if you don't, you have to go back and amend the 2020 return, which is then late penalties on any tax that would be due. Okay, and or you might actually, if you go and you pay back, depending on the circumstances, because there's at least 600,000 options now of how you could run all these different scenarios. But the point is that if you change your mind, you got to go back and change 2020. Here's why I think you just want to pay it back. You've been working hard to put money in retirement. It's not meant as a savings account. It's not. Now, I understand that we're in, and many are, and I'm sorry that we are in the circumstances that we are in. So I get that there are hardships, but you have the opportunity to pay it back. So when you're pulling money from retirement, here's the biggest right hook to you, is that between now and retirement, it doesn't get to grow. So I want you to think of it this way. If you were to pull out just $10,000 now, okay, what would that $10,000 be worth in retirement? Let's just say for grins, that $10,000 would be worth $20,000 in retirement. So hypotheticals here. This has nothing to do with back here. The numbers I'm getting ready to give you have nothing to do with these calculations. In fact, here's what I'm going to do. So what I'm getting ready to tell you here doesn't change anything that I just told you. Got some lighting. What I'm getting ready to tell you right now, so I'm waving my magic hands here. What I'm getting ready to tell you now affects none of what I just told you. Affects none of what I just told you. I'm now talking retirement, okay? So know this. If the $10,000 you're pulling out right now could be $20,000 in retirement, it's as though you just pulled out 20 grand. You didn't pull 20 grand. You only pulled 10. But by pulling it out of retirement, it can't grow. So not only did you take your 10 now, but you took out any future growth. So think of it that way, like, okay, yeah, I took 10, I only got 10. It can't continue to grow. What did it cost me in retirement? I don't have 20 grand there because my 10 could have grew to 20. And it's worse because you pull your 10 grand out, you have wages, which most likely in retirement, you don't have wages, right? Most of the time. So you have your wages. So when you put money from retirement on top of that, you're in a higher tax bracket. It doesn't make everything taxable at the highest tax bracket, but that income from the early withdrawal is going right on top, which then that portion would be whatever your higher brackets are. So not only are you paying more tax compared to retirement, in my opinion, because you have more income that you're reflecting on your return. Now, you have pure dire straits. You have not been able to collect unemployment. You have no money, no money coming in, and you pull the money out, and due to credits and all that, it's like, well, JJ, I'm not going to pay any tax, and in 2020 there are no penalties because I'm affected by COVID, and I've got $36,000 in my retirement. I'm going to go ahead and pull it out. But with, the fact of the matter, I've got 10 kids. I have a client that has 10 kids. I have 10 kids, and when I add up all the tax credits and my standard deduction, on the $36,000, I'm not going to pay any tax. So JJ, I'm just going to go ahead and pull the money now because I'm not going to pay any tax on it now. Still go to the first thing I said to you when I took this down, the first thing I said to you when I took this whiteboard down. Yeah, but the 10 that you pulled now can't grow. It's like you pulled out 20. So when you're putting money in retirement, it's for retirement, right? You didn't put money in savings. Now you feel like, well, I put it in retirement savings. Okay, we're getting technical here. You put money aside for retirement. That's what it's for. Okay, so do every other option you can before you pull out of retirement. Do every other option you possibly can before you pull out of retirement. And then the next thing is, okay, don't be like, well, I might need 50. I'm gonna pull 50 all right now. Okay, what is it that I need? Now, you can't like every 2 weeks pull money out per se, but there are a lot of exceptions this year. You can pull money out more than once during the year. But don't just then go hog wild on it. And I don't even mean that you would go and spend or waste money on it. I'm just saying that you wouldn't borrow the money from a bank if you didn't actually need whatever it is that you're borrowing typically. Like you wouldn't go to the bank and say, I might need 50 grand. Like I know I need 10, but I might need 50. Go ahead and give me 50. You'd say, well, I need 10, let me borrow 10. So think of it the same way with the retirement, right? I probably would recommend to you that if you are gonna have to pay tax on this, that you pay it over the 3 years. Be prepared for what that tax is going to be, and whatever monies you are getting, set aside what those taxes are. That 20% and that 5% on the other whiteboard is in essence a suggestion. Think of it that way. It's a suggestion. But if you're gonna pay tax all in 1 year, you would withhold 20% and 5%. If you're gonna pay tax as in recognize it over 3 years, know this, your 20% that you would let be withheld, or your 5% for state, is only going to apply to 2020. You withholding tax in 2020 will not apply to any future tax year. Which is to say, if you pulled out 36,000, you're gonna owe tax on 12 grand. Next year, you'll owe tax on 12 grand, and the following year, tax on 12,000. So you're gonna need to have tax in each one of those years. Having withholdings from retirement doesn't do anything to put you at ease come tax time, other than, I did pay some money towards the taxes. Because I'll tell you this right now, many times, money coming out, okay? You might be at a higher tax bracket. The 20% just went towards it, okay? In normal years that you have a penalty, right? So if your tax rate is 25%, you're paying a 10% penalty, you're paying 35% in taxes. This would be in another year, okay? This would be like in 2019. So your tax, including that 10% penalty, because it's just an extra tax, is 35%. So if you only had 25% withheld, you're only applying it towards whatever your tax is. So know this, if you're trying to make a decision, when I took the board down, I just want you to remember one thing. My recommendation is you don't pull the money out of the retirement unless you're gonna pay it back, because you want the growth. You pull it out now and you pay tax, it's not gonna continue to grow. So in making your decision now, go back to the 2 pictures that you took and making your decision. When I took the board down, the only thing I want you to take away post board down on the ground is what my recommendation is. All right, hey, one thing I'll just mention is that you also want to talk to your investment advisor on this, okay? Pick what stocks you're getting out of. You don't want to just say, hey, give me 10 grand. You're in probably a lot of different stocks, right? So if you have a stock down, don't pull money from that one, right? You're in a 401k, but 401k is just the doorway that your money goes through, okay? So if this area, this room over here, okay? Well, this doorway is the 401k. This doorway is the IRA. That's all that means. And then when I put money in there, now it's inside the IRA. Now it's inside the 401k. Now it's inside the 403b. When we go over here, when I'm inside the 401k, IRA, or 403b, when I'm inside this, my money's inside this, I can put it in a savings account, I can put it in a CD, I could put it in a specific stock, I could put it in mutual funds, foreign, small cap, large cap, you name it. It could be into real estate, could be technically a direct investment, right? So when it's inside here, and now you're saying, hey, I want to pull it out, and you're saying you want me to give you your money back because I'm in your 401k. You want me to give your money back, okay? Well, which one's better? Okay, the stock that's down, don't get that money. I mean, the stock that's up, makes sense that maybe you're doing that one. So you have to talk to your investment advisor. And if you are working for the government or you work for a private employer, there's an investment advisor that's overseeing that. And you need to talk to them and make sure, because if you just say, I need 10 grand, they're just going to pull it out evenly, or maybe they'll pull it out the way you hope. But the other part is you start pulling money out and then you pull it out while the stock's down, you've done even worse for your retirement. All right, hey, please subscribe. And then don't you ever forget, you've never met a CPA quite like me.
You know what it is, man. Hey, we about to crack the CPA code.